So now turning to California, as we enter 2019, we have a new governor coming in. And so that's the first image that I have up here is Gavin Newsom and Jerry Brown, the outgoing governor. And Jerry Brown is turning over a state financial situation that's in pretty good shape, an economy that's growing. That's the middle image. And the image on the right-hand side is the California bear kind of walking along through this tightrope, doing well, but now we have this volatility that David talked about and what's happening in financial markets. That's the subject of our conference today. If that California bear goes into a bear market, what does that mean for California? And in particular, what I want to focus on is some new research that we have on the relationship between those financial markets and what's happening in the tech industry. So to do this, I want to first show you some data, some trends in employment, in trade, in tourism, and in housing as we enter 2019 that are going to inform the forecast of what's going to happen in the near term in 2019. Talk about tech employment and the NASDAQ. That's going to lead us into the forecast and then some risks for the forecast. So first of all, this chart, which I show each time, I don't have to change the title because every time California has new record employment. The top line here is from the household survey. It's the number of people that are employed. We are now 16.6% above the trough of the recession. The last time we were here, we talked about how this is kind of flattened out, that we were running out of people. And now it's started increasing, but increasing really very slowly. The bottom line is the number of payroll jobs that continues to increase, that has not flattened out. So some of what's happening here is that we have tight labor markets and firms are having to convert contract workers into payroll employees with the associated benefits. So that's good news, 21.5% above the previous trough. So record employment, what sectors is that employment in? Well, what you see is the percentage growth rates by sectors. And on the right-hand side, the red, kind of the sectors that are bleeding. These are perennial weak sectors in California, nothing really new here. This is non-durable goods, this is retail, and federal government. We expect federal government to kind of neutralize with the stimulus package, but these are kind of the perennially weak sectors. The important ones are the ones that are growing, and just roughly speaking, the first four are tech, temp workers, construction workers, and logistics. And those are followed by healthcare and leisure and hospitality. So what you have there is kind of a wide distribution of jobs in higher and lower wage categories. So widespread job growth. Geographically, it's also widespread, but not quite as widespread. So the red block here is the growth rate of employment in the US. And to the left, what you'll notice is all the way over on the far left, Silicon Valley at double the US growth rate in employment. But also on the left is the North Bay and is the East Bay, and just even with the US is San Francisco, whose growth rate has slowed significantly. But you kind of add those up, and what you get is that the Bay Area is still leading California and kind of pulling California along a lot based on the strength of their tech industry. So that'll be something we'll talk about in just a moment. What is really significant here, though, is if you go along the West Bay from Sonoma, or actually the North Bay down, Sonoma to Marin to San Francisco, San Mateo, Santa Clara, each one of these counties has an unemployment rate less than 2.5%. And yet they're still growing faster, and a good bit faster than the US and the rest of California. In the East Bay, the unemployment rate is less than 3%. So this is the real performing area in the state, but also we have the inland parts of the state finally catching up with the Inland Empire and San Joaquin Valley. Over on the right, Orange County is still kind of lagging behind and has kind of through this recovery, as well as the Central Coast. Los Angeles kind of flips around between faster and slower than the US, on average about the same as the US, but over the last 12 months, a little bit slower. So now turning to trade, we've been hearing about trade wars. We're going to hear more about trade wars. This is West Coast ports, and on the left-hand side are imports. The right-hand graph is exports. Let's just start with the left-hand one. On the top is the largest of the West Coast ports. That's the ports of San Pedro Bay, Los Angeles, and Long Beach. And what you notice on imports is they bounce around a lot. There's a lot of seasonal movement in there, but the trend is not abating. We're not seeing really any change in the trend of imports. On the bottom two are Puget Sound ports and the San Francisco Bay ports, principally Stockton and Oakland, and a little harder to see because these are much smaller ports, but also a slight increasing trend. On the right-hand side, we have exports, and exports have been flat, and they remain flat. So in terms of international trade through our ports, we're not seeing any effect of these trade tensions. Turning to airports, we also are not seeing an effect of the trade tensions. These are the high-valued goods. These are the technologically sophisticated goods that travel by air. The top line is inbound. The bottom line is outbound. And this is a combination of SFO and LAX, our two major international airports. A positive trend, continue to be a positive trend. We're not seeing any change in that. And kind of staying with trade, another aspect of trade that represents what's happening in the California economy is the movement of packaged goods. And we want to look at that by the volume of cargo traffic through the main packaged good airports in California, the airport of Oakland and of Ontario, and both of them also have a positive trend. Now you see that Ontario is really moving up fast, but that has a lot to do with the transfer of management from Los Angeles World Airports to the new Ontario Airport Authority, and the new authority being fairly aggressive in their marketing. But both of them an upward trend, and again, you don't see any real recent change in these trends. Now, turning to tourism, international tourism is certainly important in California, and what you observe here is the international arrivals at LAX on the top and SFO on the bottom. In spite of a strong dollar, in spite of it being more difficult to obtain visas to enter the United States, we have record international tourism coming in through these airports, and the trend is, again, a positive trend. The one fly in the ointment in this is that we have a significant amount of tourism here in Southern California, and particularly in San Diego County, that comes via land from Mexico. So if we have continued closures of the border with Mexico, such as the recent occurrence in San Isidro, we can expect that to have an impact that's not represented here. So that's something to keep our eye on with respect to leisure and hospitality. Now, turning to housing, you've heard a lot, read a lot about the slowing housing market in California and indeed nationwide. It's happening in Dallas, it's happening throughout the US. What you see here are home prices in 3 metropolitan areas in California. This is the Case-Shiller Home Price Index. They're all indexed to 100% at the previous peak, 2007. The top line is San Francisco, and what you notice is that that is 30% above its previous peak. The next one is San Diego. That's about 15% above, and Los Angeles about 10% above the previous peak. So we've got these record home prices, no surprise to anyone. But if we look over on the right, you do see the impact of this slowing. You've got home prices are leveling out, even falling somewhat. And this is confirmed by looking at home sales. So this is single-family detached home sales. This is California Association of Realtor data. And over on the right-hand side again, you see home sales are abating a bit. But if you kind of look at that whole trend, it's just moving a little bit. And same thing with the prices. This is exactly what you would expect with increases in interest rates, right? Interest rates go up, mortgage payments go up. That means for affordability, the same house has to cost less in order to keep those mortgage payments level. So that kind of abatement in housing markets is what we expect. And it happens when sellers have to figure out, well, what's the new price that I can sell my house at these higher interest rates? And so you've got some price discovery going on. So there's really nothing worrisome here. Housing demand in California has been and remains extremely strong. That's why we have these record home prices. And for that reason, we have a forecast of, so the forecast is in the different color, so the blue color on the right. We have a forecast of increased home building in California. Unlike in the US where it kind of rolls over with the interest rates, we have a slower trend, but increases up to about 140,000 units per year. So that's good. It's not the 180,000 that we need for population growth, and it doesn't count the replacement of these tens of thousands of homes that we've lost in the last 2 years with these horrific wildfires. So we're falling behind, but doing a little better than we were before. So our forecast is for home building to achieve about the levels we had in 2000 and 2002. So that brings us to talking about tech and financial markets. So I'm going to take you through a series of slides and show you some associations. And what we see here is on the horizontal axis is tech employment. There's no real tech sector. So representative of the tech sector, we're using the combination of information and professional, scientific, and technical services. So this is the growth rate, the average annual growth rate from 2011 to 2017 on the horizontal. On the vertical is total payroll jobs, and again, the average annual growth rates. And you notice that there's a positive association between them. It's not an exact relationship, but there is a relationship between them. They seem to move together, and that's certainly consistent with the narrative of the tech industry being one of the drivers of California's expansion over the last decade. Now, moving to the way in which tech is financed, so on the vertical axis we have here the amount of venture capital investment in California. It's the annual amount. So these are, each dot represents 1 year. And then on the horizontal is the NASDAQ, which is the tech equity exchange 1 year previous. So the way in which this works is that the NASDAQ provides two elements that funds the tech industry. One is it provides an out for venture capital firms to IPO and sell companies that they own. That gives them the funds to reinvest if there's good investment, if there are good investment opportunities, which brings to the second, the NASDAQ provides a metric for valuing new firms, right? Because the price earnings ratio allows you to value those firms. The higher the price earnings ratio, the higher the expected rate of return of that investment, the more investment. And so it's not surprising that we have this relationship that the higher the NASDAQ last year, the more venture capital investment we'll have this year. So kind of moving this one step forward, that venture capital investment that was on the vertical, we move that to the horizontal and compare it to tech employment. And contemporaneous tech employment, no surprise there, we get an increase in tech employment. And so as you think through this, what happens with the NASDAQ this year affects venture capital investment next year, affects tech employment and the growth in the tech industry, and overall affects growth in California. So what's been happening? Well, we saw the NASDAQ drop a lot yesterday, but remember, this is annual averages, not just those fluctuations. And so if we look at what's happening in the NASDAQ, so what you see here on the top, that line, the scale is on the right, that line is the monthly average, not the annual, and the annual was in that analysis before. That's the monthly average NASDAQ, and it goes back to December of last year, so it's 12 months. And we just draw a line across here, and what you see is that the NASDAQ is slightly above where it was before on that monthly average basis. So not a cause for worry for the coming year. But on the right, you see the NASDAQ is sort of trying to trend down. A couple of months doesn't quite make a trend, but it is a break in the pattern. If that continues and becomes it becomes a bear market in 2019, it has real implications for the strength of the California economy in 2020. And then just for reference points on the bottom, using the left scale is annual growth rates. So there's year-over-year growth rates for Silicon Valley and San Francisco, and that's in employment. And you see that hasn't really been changing very much. It's good growth rates, but it hasn't been accelerating or decelerating. So what are the implications of all of this for our forecast? The first one is that trade wars have not yet had an impact on trade through our ports. The second is that new visa requirements and a strong dollar have not yet had an impact on international tourism and hence the leisure and hospitality industry in California yet. The housing markets are reflecting higher interest rates, and so we don't see a slowdown in residential construction, again, yet. Financial markets have not yet had a negative impact on venture capital investment and hence the tech industry. So all of these lead us into 2019. So Governor-elect Gavin Newsom should be really happy about this, that what they portend is entering 2019, positive economic trends, which should continue, but as with the US, we're expecting slower growth in 2020. So that brings us to the forecast. So we've got 2% to 1.5% growth in payroll employment. Next year, slowing to 0.9% the year following. We have good personal income growth. Unemployment rate will be elevating slightly along with the US to 4.5%. And housing starts on average about 136,000 in 2020. By the end of that period, an annual run rate of about 140,000. But there's some risks to the forecast. And they are risks that you've already heard, but bear repeating. The first is trade wars with China. So trade wars with China could disrupt trade in California, could disrupt the manufacturing of technologically sophisticated goods sold to China and other parts of the world. But let's not forget that the trade dispute with the EU is not settled. And the new agreement that was signed with Mexico and Canada requires US congressional approval, requires Mexican congressional approval, and there's a new government there, requires Canadian Parliament approval. So this is not yet a done deal. And of course, the last threat, which we're going to talk more about today and listen to our keynote and our panelists and get some insight, is a bear market, particularly in the NASDAQ. But with that, we've talked a lot about this trade war with China. And so that's a nice segue for Professor Ed Leamer to tell us about trade wars. Thank you.